This is Ag Matters PM from the Iowa Agribusiness Radio Network, brought to you by the Iowa Soybean Association, your source for the latest Iowa ag news headlines right here in the heart of the heartland. With reports from our award-winning team of Dustin Hoffman, Riley Smith, Mark Magnuson, and Andy Peterson. Now, from the IARN studios in Des Moines, here's Dustin.
Hello, everyone, and welcome to Ag Matters PM from the Iowa Agribusiness Radio Network. I'm Dustin Huffman. Today's Monday, the 16th of June, 2025. So glad you could join us here today. Coming up a little later on in the program, we'll talk with Robin Schmahl of agmarket.net to find out what happened in those closing markets. But first, we're going to talk with Iowa Renewable Fuels Association Executive Director Monte. Last week, we got the RVO numbers from the EPA, and we talked with Grant Kimberly earlier last week about the biodiesel side of it. Now we're going to look at it from ethanol's point of view. We're here on the Iowa Agribusiness Radio Network, and we're sitting down right now with Monte Shaw of the Iowa Renewable Fuels Association. Monte, thanks so much for taking the time to visit with us today.
Hey, thanks for having me here. Appreciate the opportunity.
All right, so the end of last week, we got word finally from the EPA concerning RFS, RVO. I know I've been waiting for those for quite a while. Tell us what the numbers look like coming from the ethanol industry.
Yeah, well, there's a lot to like in the proposal. Now, at this point, it is just a proposal. There will be public comment, and usually there's some changes, so we'll have to see what those are. But first and foremost, the overall RVO was just over 24, the blending level set was just over 24 billion gallons, which was a record number, and by quite a bit. And that was good because really the previous rule that had come out that covered this year and the two previous years had really missed the mark. They had really underestimated the demand for biodiesel and renewable diesel, and it kind of trickled down through everything. So we think this is a very strong position to start from with the overall number. You have the implied 15 billion gallons for conventional biofuels, which is kind of your corn ethanol. And then for the first time, EPA did the biomass-based diesel number in RINs instead of gallons. So we have to kind of make sure we're comparing apples to apples there, but it was a fairly robust number. There's some other changes we can dig into, but we just think as a starting point, it was very good news.
As far as ethanol, now we've known for years that the last administration was so big on electric vehicles, and that was something that nobody really shied away on that topic in the ethanol industry. Is this kind of showing that support again from the administration that, hey, ethanol is going to be a viable part of our future and our energy independence going forward?
You know, I think so. They did formally remove what are called e-RINs. Those were kind of RINs for electric vehicles that the Biden administration had tried to put in. They really didn't fit. I don't know if they would have held up to legal scrutiny, but it's just nice not to have to worry about that right now. There's still plenty of other things out in other parts of the policy and tax code that are favorable for electric vehicles. So they did not need to be in the RFS, the renewable fuel standard, which is the one thing for renewable liquid fuels. So we were happy to see that. They also made some changes in how they propose to generate the RFS credits based on whether the fuel or the feedstock was from the United States or whether that was an imported feedstock, for example. I think that will get a lot of comment. Just speaking from my own membership of our trade association, the Iowa Renewable Fuels Association, we have members that are probably pretty split on that. So we're going to be talking to them here in the next basically 48 hours and seeing if there are places where we have some consensus that we can comment on. So there's, even though the overall numbers were great to begin with, there's still a lot to digest. That, and then really, to me, the 500-pound gorilla sitting in the corner of the room are the refinery exemptions. It's pretty clear from statements that the EPA administrator made before Congress here recently that they plan to work through the backlog of these refinery exemption requests that, due to court cases and other things, go back, I don't even know, 7, 8, 10 years, potentially billions of gallons of impact. So, we'll be strongly encouraging the Trump administration to continue the process they had before of reallocating any refinery exemptions so that the overall numbers don't go down. After all, if you set a 24 billion gallon RFS, which is a record, but if you then granted 8 billion or 6 billion gallons of refinery exemptions and didn't reallocate them, you're really not setting a 24 billion gallon RFS, it'd really be 18 or 16 or something and be very, very weak. So they indicated their plan was to reallocate, but as we know too often in these policies, the devil's in the details. So that's something we'll be keeping a very close eye on.
And Monte, if you would, for some of our viewers here, could you maybe just give us a very generic difference of what the RFS means versus the RVO, so people maybe understand better what we're kind of celebrating here?
Yeah, I've tried very hard to not use too many acronyms, because on this one, I mean, you could go RFS, RVOs, SREs, RINs. I mean, you could really confuse people, but it all comes down to the bedrock policy in this country called the Renewable Fuel Standard that was first enacted back in 2005. EPA then sets annual, or in some cases now multi-year blending levels. We call those RVOs, but I try to just call them RFS blending levels because that makes more sense to people. And they're tracked by these credits and different things. But what we're really talking about here is the EPA in this proposal is setting the blending levels for 2016. Excuse me, just a decade off there. I'm getting old. They're setting the proposed blending levels for 2026 and 2027 to take off for the current rule that ran through the end of this year. So this is a proposed rule. There will now be a chance for public comment for at least 30 days. And then they would take that into consideration before finalizing the rule, hopefully by October. And so we're going to be very engaged to make sure that those blending levels stay robust, to make sure that they are not undermined by these refinery exemptions where refiners can actually get out of their blending level requirements. There's a process where if you grant an exemption to one company, their portion of the level is redistributed amongst everybody who didn't get an exemption. That way, renewable fuels are held harmless. That way, 15 billion gallons for ethanol would be 15 billion gallons. 5 billion gallons for, or I guess basically they're estimating 5.6 billion gallons for biodiesel would be 5.6 billion gallons. It wouldn't be reduced, and that's the key thing. We want good, solid numbers up front, and then we don't want them escaping out the back door through some regulatory action. So again, I mean, really, this is probably the most positive I think I have ever been on the draft of a rule. Now, I hope, I'm going to knock on some wood here. I don't want to jinx us for what the final rule might be. I'm sure there will be people with other views pushing back, but we should be pretty happy with the starting point here. And now we just have to make sure that they don't do things that undermine the good beginning here.
And of course, Monte, we know that the Iowa is obviously the top producer of ethanol in the country, and we've had some tough difficulties those refineries have had, in the last couple of years because of the way policy has been dragging out. What's this going to mean for those refineries, the communities that rely on them for employment, and also part of their economy? I mean, what's this going to mean?
Yeah, I mean, the overall farm economy has not been very solid the last couple of years, and quite frankly, it's because the renewable fuels economy hasn't been solid. We saw the largest 2-year drop in net farm income over the last 2 years that we've ever had in absolute terms. And even if you do it on a percentage basis, you have to go back to the 1930s Dust Bowl era to find 2 years where farm income dropped as much as we just went through. That's not the comparisons we want to be making, the Dust Bowl. So we have an ethanol plant in Iowa that shut down. We have a number of biodiesel plants that are shut down right now. There were more, a couple have come online, but we still have several that are offline. And so, a strong, robust, renewable fuels blending level can help that. Yes, there's tax policy. Yes, there's all these other things out there that can influence it, even the world events happening in the Middle East right now. But those renewable fuel standard blending levels are kind of like the base that we work off of. And so it's too soon to know if these numbers are strong enough that, hey, everybody's going to, flip the switch and be producing tomorrow. But, all we can do as a policy, is with the policy focus is try to get the best, most robust policy numbers we can, and then the market will sort out the rest. So, I think that, I don't want to say that this is going to fix all our problems, but these numbers are pretty strong and probably, about as good as we could hope for. And so if they stay that way and they're not undermined by exemptions and things, I think it does set the stage for a little bit of a rebound here. At least I hope so.
As you mentioned, the comment period is now going on. What can producers do to help get their voices heard?
Well, I haven't even dug in since Friday on what the actual, portal is, but the EPA will have a portal on their website, or you can always go to regulations.gov, and any member of the public can submit a comment that just says, whatever you want. It can be a one sentence comment. Obviously we'll do more in depth and technical comments as well, but people should, just say, hey, these are important. We need to get these numbers right. When we didn't get them wrong, when they got them wrong, and I'm not trying to kick sand in the Biden administration's face here, but they really did blow setting the renewable fuels blending levels for biodiesel and renewable diesel over the last 3 years. And it had consequences. We had plants shut down that probably didn't need to shut down if they'd have just, kept their foot on the gas and realized what was going on in the marketplace. So getting these numbers right does have real consequences. And if those plants shut down, it's not just the jobs there, it's the local basis price for corn, if it's ethanol, for soybean oil or animal fats. All of ag is hooked to this. Renewable fuels is really what's driven that marginal demand for corn and soybeans over the last 20 years. It's what's allowed us to add a lot of value to the farmland that we have out there. And I just hope your folks that are watching this, listening to this, they understand that that's not a given. It's not an automatic. We can go backwards. We could go back to the 1990s. We could go back to the 1980s. I don't want to, but we have to keep demand strong. And one of the best ways to keep demand strong is to keep demand for renewable fuels strong. And that's where this renewable fuel standard blending level policy comes in and sets that floor that then we try to work off of and go even farther. But if your foundation is shaky, it's hard to build on top of it. So that's why we put so much focus on this particular rulemaking.
All right. Well, Monte Shaw of the Renewable Fuels Association of Iowa has been our guest. Ani, thanks so much for taking the time to clarify some things for us.
All right. Anytime. Thank you. And we'll be getting our voice heard out there on these things.
That again was Iowa Renewable Fuels Association Executive Director Monte Shaw. We're going to take a short break and hear from our sponsor, the Iowa Soybean Association and the Soy Checkoff. When we come back, we will hear about the closing markets from agmarket.net. This is Ag Matters PM.
Iowa Soybean Association is driven to deliver for Iowa's 40,000 soybean farmers. We're proud to provide objective agronomic research, a helping hand with soil and water stewardship, and timely industry news powered by the Soybean Checkoff. Learn more at iasoybeans.com.
It's time now for the Ag Matters PM Closing Market Summary, your source for market analysis and settlement prices from the day's trade in Chicago, courtesy of the folks at agmarket.net. We're back on Ag Matters PM, and at the end of the trading day, it's time to talk with Robin Schmahl of agmarket.net. I know, Robin, we started the day, boy, corn was just taking it square on the chin. Did it get any recovery, or did it just kind of keep taking its punches here today?
No, we didn't get any recovery. It stayed under pressure. We saw significant pressure on corn. Soybean meal saw a lot of pressure. Wheat was down, similar to corn, not quite as much. We're looking at decent weather right now. Crop conditions, they're expecting to increase 1% from last week. We're looking at an estimate right now at 72% good to excellent on corn. So was 71% last week. Soybeans at 69%, up 1% from last week. And spring wheat at 54%, also up 1%, and winter wheat at 54%, even with last week. So we're not seeing anything on the weather front per se, or the crop conditions front right now, and we're marching along on time. So normally we say, they always have said in the past that July 4th weekend can be a real turning point or whatever, but I don't know, at this point in time, we're looking at some decent stuff. There are some places where, when we get the end of the month report for acres, there's going to be some prevent plant and stuff like that, but that's not an issue right now. We did have good corn export inspections at 1.673 million metric ton. The expectations were 1.350, but that had absolutely no impact on the market at all. They were just focusing on, the funds added more shorts to their commitment to traders report. So the market is just in that negative mode right now. Soybean export inspections were 215,803 metric tons, below the 315,000 estimated. Wheat was at 388,752 metric ton. That was above the 315,000 estimated. So the big news primarily that supported the bean market to some extent was the NOPA crush report. The soybean oil stocks were significantly lower than were anticipated. They were at 1.373 billion pounds. The estimate was 1.451, and in May it was 1.527 billion pounds. So that caught the trade off guard to some degree because of that. And so that added to the bullishness of last week, where the EPA changed the mandates they were looking at for the biofuels. Was estimated, the blending mandate was estimated at 4.65 billion gallons. EPA announced 5.61 for 25-26 year and 5.86 for 26-27. That really sparked the market, the soybean oil market last week, which limit up move. Today we moved expanded limits higher. Just before the close, or at the close, we were locked limit up in expanded limits in the July contract. We had backed off of limit in the subsequent contracts, but that's really, I mean, you look at the chart, we've got gaps. It's just a lot of movement in there, supporting the soybean market to some degree, but not having much impact at all on any of the other markets out there. So that's the bullish news. So that's what really created quite the dynamic between corn, soybeans, meal, because higher crush is going to put more meal on the market, and we're not getting the volume of oil that was anticipated. Even though oil crush is good, demand is there. And then relative to, the corn and wheat markets.
All right. Well, and switching gears to the livestock side of things, I know on Friday, cattle end of the week really also taking a shot. And how did they recover this week, or how did they start the week? I should ask here as we're looking at livestock with cattle and hogs both.
Well, mainly the markets almost recovered everything they lost on Friday, especially feeder cattle, very close. Live cattle a little bit shy of that. So the Fridays seemed to be tied more to closing the chart gaps underneath, which live cattle did a number of that. Maybe trying to correct a little bit in an overbought situation. Some of the funds or some of the traders taking some profits ahead of the weekend. The other thing was northern dressed cattle last week traded steady. And that's been 8 weeks since we saw any steady cash trade. So even though southern live cattle were $5 higher, the northern dressed just showing steady put up a little bit of a red flag. So that triggered the liquidation. However, when we take a look at everything as a whole, President Trump now backed off on raids on packing plants, farms. So that added to some bullishness again to reverse everything. So we're going to see this volatility, but that's the fundamentals are positive. So the Friday's move was more technical, more, if you want to call it freight based or whatever, that they want to take some profits just in case. Now, at the midday report today, box beef was up $2.03 for choice and up $2.67 for select. On the hog side, June went off the board on Friday. July was carrying a premium, but it pushed higher. We pushed quite a bit higher. We gapped open. Every contract is making new contract highs. We've got a bullishness that has developed under that market. Cutouts were up 87 cents at the midday. They were up strong all last week. The cutout values at midday are at $1 or $118.93. That's really, when you take a look at how that's been moving, that's provided a lot of support under the market. The National Daily Direct hog report this morning was at $2.51 higher. Very unusual for Monday. If you recall, last week, Monday, we were higher too to start the week. So the packers are being aggressive, even though don't have good packer margins. It seems like the numbers are tightening out in the country. There's not been a lot of news at that. There's been anticipation of that, but the demand is increasing and the packers are becoming aggressive. So China's custom agency acts as well. They approved 23 pork plants for export eligibility. So maybe we'll start to see a little bit more of that showing up on our weekly export sales, but we've got strong support under both the beef and hog market.
All right, Robin. Well, lots of things for us to be considering here. If folks want to talk about some of their market strategies and what they should be thinking about, what's the best way for them to get in touch with agmarket.net?
They can call me directly if they would like at 877-256-3253 or go to our website. There's an 844 number. They can go ahead and call that number and somebody pick up the phone and be glad to answer their questions.
All right, Robin, we thank you so much for the insight, and we'll talk to you again real soon.
All right, thank you, and we'll see you next week.
That again was Robin Schmahl of agmarket.net. Let's go ahead and take a look at the closing numbers on the Iowa Agribusiness Radio Network market screen. At the close, July corn was down 9 3/4 at 434 3/4. Soybeans were unchanged at 1069 3/4. Soy meal down $8.20 at 283.70. Soy oil was limit up at 450 at 55.11. Chicago wheat 7 1/4 lower at 536 1/2. Kansas wheat down 4 3/4 at 536 even. Minneapolis wheat down 11 1/2 at 622 3/4. Oats down 7 cents at 379 1/2. On the Merck live cattle up $3.10 at 215.55. Feeders up $3.80 at 310.22. Lean hogs up $2.32 at 111.80. Pork cutouts up $1.15 at 116.92. Class 3 milk down 17 cents. And that's been a check of your closing market recap, and that brings us to the end of today's show. You can find all our content online at iowaagnet.com, as well as follow us on Facebook, X, and our YouTube channel. Don't forget to subscribe and hit the bell icon so you're notified each time we put out a new video project. Also, don't forget about the replays of Between the Pods, Pods of Potential, Weekend Ag Matters, Iowa Ag Matters, and much more, all available online under the podcast channel, iowaagnet.com. Also, free market analysis sent right to your mobile device through those Iowa Agribusiness Radio Network podcasts on Amazon, Apple, YouTube, Spotify, and Podbean. From the iAron Studios in Des Moines, I'm Dustin Huffman. For Ashton Jolly, Mark Magnuson, Andy Peterson, and Riley Smith, we thank you for watching. This has been Ag Matters PM.